morning to all our invited guests. A very warm welcome to Momentum. We are excited that you made time out to be with us today. I see that GIPF is here, NamPost is here, Bank of Namibia, NTA, Namibri, B2 Gold, NamPower, First Rand Retirement Fund. So a good representation. So thank you very much for making time out to be with us this morning. I think it's what we're hoping for today is we're hoping for a very insightful, relaxed morning where you're going to get insights in our view or how we view the markets, how we view the current events that are currently happening in the global economy, in South Africa and in Namibia as well. But most importantly, it's just an opportunity for us to reconnect again after having been seeing each other just through computers. It's important for us to reconnect again after such a long, what seems like a lifetime of isolation. So thank you once again and welcome. Now, for those of you that are very detailed oriented, I think you can see that our M has been flipped upside down. It's not by mistake, it's not a mishap. It's a tradition that we have adopted for the last 4 years in a row now, where during the month of August, we flip our M to a W in all the markets that we operate in celebration for Women's Month of August. And we do that to recognize the women that deem success as important, but at the same time also acknowledging that success is as unique as individuals are unique. So that is really our small contribution as a brand to say that we do honor women and we understand the importance of women also playing their role in the market as well. Now, the times that we find ourselves in, very uncertain times, and those are the times that informed the theme that we chose for our engagement today. And that is the road to successful investment outcomes in uncertain times. But I think it's important to always reflect back to history, because sometimes when certain events do occur, the natural reaction of a human being is to think that maybe this is happening for the first time, or we're finding ourselves necessarily in new times or new norms. But I think if you look back in modern history, I think as far back as the 1929, the Wall Street crash that was recorded, and thereafter there was a Great Depression of almost about 10 years, 1929 to 1939. And thereafter, even fast forward to the 70s, you had the oil crisis. And then you also have other financial market crises in between. You come forward, fast forward again to the 90s, and the 2000s is the dot-com crisis. And then, of course, the other crisis that really caught us, I think, in my mind, off guard, when we thought that we have become more clever, and we thought that maybe correction is a thing of the past, and that was the 2008-2009 global financial crisis. That also very hit the world, and again reminded us that markets do correct themselves. So what we're saying is that if you look back at history and where we find ourselves today, that crisis, financial events, and economic crisis are not new phenomena. It's events that have happened in the past. And I think the world has, over time, also learned key lessons in how to respond to this crisis. Now, having said that, I think there are nuances that we are seeing in what we have experienced in the last 2 years. COVID, for one, but also I think the frequency at which the certain key risk events have been happening, and therefore the volatility in the market. We think that has heightened compared to history and how we have seen trigger events happening in the time in between. I think that has increased, and we need to acknowledge that. But I think we need to take comfort in the fact that the policymakers have learned a lesson from history, and they have somewhat now at least, and we hope, that they know what not to do at the very least. But I think at the bare minimum, even with COVID, we have seen that the response from the policymaker, from the central banks, have been quite quick and fast for us to be able to, for the markets to recover again. Now, the other key lesson I think that we learn is the fact that if you consider what has happened in the 30s and 1930s and the 1970s, is the fact that the world has now become more interconnected. So any trigger event that is happening in the US or in Europe or in one of the emerging economies can quickly find itself to the rest of the world, can quickly find itself in South Africa, and by implication in Namibia as well. But the opposite is also equally true, that when policymakers then respond, for example, if the US Fed decides to take a reaction or to make sure that they try to revive the market quickly, that is also passed through to emerging markets, South Africa, and we see that in Namibia as well. So the global being now interconnected, it's not just a negative thing. I think it also has positive implication that comes out of that and that we see in the market performance. And then I think another important consideration is that markets always recover. Markets always recover. That's what we've learned over time, that regardless of what seemed to happen, markets always recover. It's a question of when and how fast, but the reality and the fact is that markets always recover. Now, for the investor then, with those reality, and it's really a consideration of how do you position yourself or how do you react in an environment of heightened risk. And at Momentum Investments, we pride ourselves in our outcome-based investment philosophy, and that is a philosophy that seeks to prioritize the investment goal of a client, making sure that we understand what the goal of the client is, and making sure that within the probability that we deem that is decent, that we increase the probability of the client getting to their investment goals. Even at the back of all the risks and the volatility in the market, we stick to our outcome-based investments philosophy. And therefore, as we go on through the program, my colleagues Yaku and Mesh, they will touch into the details of our outcome-based investment philosophy and also the offerings that we have to the Namibian investors. And then, of course, Vaughan, my colleague Vaughan, will also then come in to just really give us a feel and a solution around in the times that we find ourselves of heightened risks. What are the potential solutions that are available for instance, a pension fund, for example, for members especially that are nearing retirement and who no longer have time as a benefit in terms of their investment horizon. Time is no longer a benefit to them, and therefore Vaughan will then look into the available solution for those type of investors. And then, of course, before we go into portfolio investment specifics, my colleague Sanisha will just then briefly look at the global themes. What are those key global themes that we deem very relevant in how we're positioning our portfolios, and then also looking at South Africa. Now, before I give over to her, let me just briefly look at some 4 key themes that we think are relevant for the Namibian market. The first one, the first one is around growth and the recovery. Now, in the instance of Namibia, we do know that even way before COVID, we were worried about lack of growth. No growth at all. In fact, negative growth. No growth means zero. Negative growth. So as from 2016 already, the economy registered negative growth. Then COVID hit. The situation even then got worse around this period of COVID. So from a recovery point of view, and this is the view of the central bank, the Bank of Namibia colleagues are here, is a view of the central bank that the economy is going to recover in 2022. We're going to see a bit of growth up to 2024. Now, we need to say this, and this growth is largely going to be driven by the mining sector, the diamond mining especially, output. but there's still risks, especially from the external shocks. If, for example, and that is why I wanted to start with this, so that when you go to the global themes, you'll be able to quickly then see how everything links up and how that is relevant for the Namibian market. More so because, especially for your institutional investors, that by law, we are expected to keep 45% of your funds within the Namibian market. And therefore, the macroeconomic environment matters very much so. So we expect to recover at about 3.2. I think the original view in February was about a recovery of 3.5, but we see that there has been a downward revision on that growth because of the uncertainties and the volatility that has come through the market. Again, mining sector, some of our sectors like tourism, there's a bit of recovery there, but there are sectors that had driven our economic growth in the past. For example, construction, that is still struggling, and I think that it's still going to maintain negative growth unless something drastic happens and there are some targeted programs there. So that is the issue on growth, that yes, small recovery that you're expecting. And I say small because we are a developing country with an unemployment of about 30–40%, depending on who you're talking to. It can even quickly go to 50% if you just consider youth unemployment. And therefore, a 3% growth is a growth, but it's not really that much. So that is the first theme. Then the second theme is around debt. And I know that if you look at our debt to GDP ratio and you compare, for instance, to other countries, let's say in Europe and so forth, we'll come out as if we are okay. I mean, forecasting, the outlook is such that 2023, about 71% of debt to GDP. But if you consider of where we're coming from, we are a country that used to run budget surpluses, and we had very low debt levels. But the pace at which we ramped up debt is from the period of 2016 to now is very high. And whereas at the back of that, of course, we also got downgraded around March, April. But at the back of that is also the fact that our growth is also, a 3% growth. And therefore, our view is such that if we do not quickly find a plan to get us to high level of growth of like 7% and we continue to just grow at this minimal rate, that our debt will remain one of the key risks point for Namibia. And I think Mesh is going to just comment on how we're positioning ourselves, positioning the portfolio around the fixed income. So this is the second theme. And then the third theme that is keeping all of us awake is inflation, prices. Outside earlier, we're discussing around petrol prices and what is happening there. Now, in inflation, whereas historically, if you look at the historic data of Namibia, whereas it will probably not be the first time that we registered an inflation rate of 6.8, just nearing 7. What is concerning, however, I think is the pace of increase. That just between October, November, and July, inflation quickly increased to 6.8%. Now, again, related to that is the fact that inflation in Namibia is largely a function of your supply side issues, like your petrol, oil, and then if you also to add a spanner in the works is the fact that longer term inflation is largely explained by imported inflation in the case of Namibia. So the inflation we import from South Africa comes through to our inflation, and then of course utility prices and all of that. Now the current inflation that we're seeing currently is really driven by two components, that is petrol and inflation. I mean petrol and food prices. And that is where the risk is coming from. Now, what we're now seeing is the fact that the central banks have now started to increase interest rate. Now, the other concern with inflation as well, especially for long-term investors and for investors, is the fact that your real returns on your portfolio now get under pressure because of the increased inflation. So for the central bank now, with their hope to try to contain inflation. The question is, how do you contain supply-side shock inflation? But that's a debate of another day. Is that the central banks have now started to increase the interest rates. And then, of course, we know that because of our currency peg, 1-to-1, we need to make sure that our repo rate is aligned. Now, just in the period of January to August, we increased our repo rate by about 175 basis points. So these are the times that we find ourselves in as a country, that very key points, growth that is really recovering, but at a very slow pace. Our hope is such that we'll be able to recover faster with some interventions. And then, of course, now the new challenges that are emerging from inflation, from prices, and then the interest rate hike cycle that we find ourselves in. Now, my colleague Sanisha will give us sort of like a background as to what is happening in the global market, that in that background somewhat will also then explain as to why we're finding ourselves in this situation as Namibia. Now I'll hand over to Sanisha, and then once Sanisha has done presenting, we'll then take some questions, if any. But before that, and I thought about this, whether I should say something, but I think as Namibians, and when we talk about growth and recovery, then quickly one has to mention something about the oil recovery and green hydrogen. Our view is that this is probably a medium-term play for one. Once we then fully confirm the commercial viability of the oil, I think maybe, and plus the hydrogen, it's really maybe a medium-term play at best, not at best, at great, 3 to 4 years, at best, 6 years, 5 to 6 years. So that is our view on it. And therefore, in our consideration for 2022, 2023, 2024, oil and hydrogen does not feature at this stage. Thank you.
Good morning, everyone. I'm actually not going to use the podium. I'm very awkward behind podiums. I just want to say a big thank you to our Namibian colleagues for a very warm welcome in Namibia. It's my first time here, my first time in Windhoek. I'm absolutely loving it. I don't really like the hustle and bustle of Joburg and Gauteng in general, and it's been very serene and tranquil, as my colleague Jako has pointed out. And I think my only regret is to not have booked a longer time period here. So hopefully we do see you again in future. I've entitled my presentation, A Confluence of Calamities. And this is a title that came through from some sentiment that was expressed by the IMF Managing Director when she spoke about the consequence of all of these overlapping crises that we are experiencing as a globe. So of course we all know about COVID-19 that broke out 2.5 years ago. We then entered a period of global supply chain disruptions which came through. And just as those global supply chain disruptions were beginning to abate and we started to see trade flows and the movement of people starting all over again, we were then whacked by the Russian invasion of Ukraine on the 24th of February. And all that did was add another layer of complexity to global financial markets and to commodity markets. And so we had the third crisis arising from that, which was high and rising inflation. On the back of that, we then saw people becoming very worried about hawkish central banks and the fact that interest rates were going to rise by a lot more and a lot sooner than most anticipated at the start of the year. We then entered what we would then say is the fifth crisis that sort of emerged from there, as people started to become very worried about, for the potential of the global economy to sink into some sort of economic slumber on the back of these tight interest rate increases. And so this is where we're sitting today. It's a very unique situation. In past history, in living history, we haven't actually experienced a time like this with these overlapping crises. Now, if we look at the Global Fund Manager Survey that's conducted by Merrill Lynch every month, you can see that for August, the main concerns are now bypassing the old concerns of COVID-19 and the Russia-Ukrainian war. It seems as though those are not seen as the major tail risk to financial markets at the moment. What is seen as a major risk to financial markets is inflation, as Evangelina pointed out. With regards to inflation, investors are worried that it's going to stay high. As a consequence of that, they're also very concerned that central banks are going to become ever more hawkish. With more interest rate increases now embedded into expectations, markets are very worried about the potential for the global economy to sink into a recession. I'll also point out that global uncertainty is again on the rise. Now, we saw this global uncertainty index spiking during the COVID-19 pandemic. Now, this COVID-19 pandemic saw a peak over the course during which this index was calculated. This is an index that comes through from the IMF and the EIU. And what this calibrates is the number of times words like uncertainty crop up in newspapers. And so now you can see that the latest bout of uncertainty has essentially been born out of the Russian invasion of Ukraine. And what the IMF says to us is that whenever we see this index spiking like it has in the past, we are often followed by a very weak economic growth pattern. So again, going forward, we are expecting much weaker growth to emerge from this highly uncertain environment. Now, we're seeing global growth forecasts being downgraded across the board. And just to give you an indication of how bad those downgrades have been, the IMF shows us on this left bar that about 70% of the economies that they cover for 2022 have been downgraded in terms of their GDP assumptions. Now, if we had to break that up a little bit, and we start looking at the various composites, you can see that downgrades have been far more extensive for your emerging markets that are net importers of things like food and fuel. Because food and fuel prices have skyrocketed, they've really been at the coalface of the global supply chain issues, it then stands to reason that these commodity importing nations are going to experience some negative backlash, more so than the average market. Now, not only have we seen global growth forecasts being downgraded, we've also seen the range of economic forecasts remaining very wide. And again, this ties in very nicely with what we're seeing with global policy uncertainty remaining very high. It's a very uncertain environment, and this is why we're seeing a lot of volatility in financial markets currently playing out. Now, as global growth forecasts started to trickle lower, we actually saw global inflation forecasts trickling higher. And what the World Bank shows us here is that for the countries that have some sort of inflation target in place, we've actually seen inflation breaching the target for almost all advanced economies and between 80 and 90% of emerging markets already earlier on this year. And just like we saw the growth forecasts, the range of growth forecasts being very wide out there because of this high level of uncertainty, it's the exact same thing that's playing out on inflation forecasts. So again, that range of uncertainty has been extremely wide, even on the inflation front. There we go. Now, as I said, this third crisis that has emerged with high and elevated inflation, we believe is a symptom of the demand problems in the globe and the global supply chain disruptions that we've experienced, firstly because of the pandemic, but secondly because of the Russia-Ukrainian war. Now, a couple of years ago, not many of us knew what a semiconductor was. Now we all know how important semiconductors are when the automotive industry all but collapsed during the global pandemic. Now, the reason that everyone is very worried about Taiwan and China's potential invasion of Taiwan, I mean, Taiwan is less than 1% of global GDP. Why are we concerned? Because Taiwan is a key market in semiconductors. And it's not that easy to go and set up another semiconductor plant. It takes between 1 and 2 years. It's very expensive, and you also need a lot of skills. So that means that if we do get the tail risk of China invading Taiwan, we could then see another overlapping layer of inflation coming through, and that would hit hard on global supply chains. I've also pointed out that rising protectionism has caused this recent bout in inflation. We're starting to see a step away from globalization. Now, in the past, countries would then source their inputs from the countries where they could find it at the cheapest rate. But now we've all seen what it means to be so overly dependent on certain regions of the world, and now countries want to become more dependent on themselves and independent on themselves, and as a result, they actually want to onshore a lot of their manufacturing. And by doing so, we've had this rise in protectionism, but because they were not the best in the world to produce these goods and services, it means that initially you're going to have higher inflation to start up those production processes. The two on the right-hand side there, the shortage of fertilizer and the restrictions on moving grain, are all related to the Russian invasion of Ukraine, given that Russia and Ukraine are key suppliers in those fields. I've also highlighted the issue around labor. We all heard about the great resignation that took place during the pandemic. It essentially meant that there were fewer people participating in the labor market. Friends of mine who stay in the UK and US told me that as you're walking down the streets, there were tons of signs in the windows for shops looking for bartenders and waitresses. So that meant that there were a lot of job openings available, and businesses were willing to pay up for these job openings. That also pushed up wage inflation, and as a result pushed up headline inflation. We all know about the logistics issues, and I just want to touch on pent-up demand. So case in point, the US actually gave consumers checks to spend in the economy. So when lockdowns were eased, these consumers went out, they had checks to spend, and then they started buying goods, but the companies that were producing the goods didn't make enough for that demand. And as a result, we then had demand-led inflation that came through. I'm obviously standing in a very bad place for this pointer. Fortunately, however, we have started to see signs of inflation topping out. The first sign for me is coming through on the wage side. So if you look at this chart on the left-hand side, it basically shows us the relationship between what companies are willing to pay up for labor versus the job openings that they are available. So we saw quite a steep relationship taking place. There were many job openings, and so businesses were willing to pay up for those jobs. However, if you flip over to the April part, you can see that that slope of the line has declined somewhat. So now businesses are not as wanting to pay up for the job vacancies that there are available in the market. Why? Because we've seen interest rates going up, and businesses are worried that consumers are going to come under stress. So if consumers are going to come under stress, maybe they don't buy as many goods, maybe you don't need to hire as many workers, and as a result, they're not really willing to pay up as they were in the past. That leaves us with potentially wage inflation topping out. The second dynamic that is played out is on global supply chains. Now, we know that global supply chains were very tangled during the pandemic. They became even more tangled with that additional commodity price shock from the Russia-Ukrainian war. But fortunately, what we're seeing on this chart, and this all relates to manufacturing data, it shows us that supplier delivery times are now beginning to shrink. So with those lines drifting higher, it means that there are actually less capacity constraints in the system, not only for developed markets, but also for emerging markets. And then I'd add a third reason as to why we are seeing inflation topping out globally. This is on the back of pent-up savings now starting to be whittled away. So again, we had precautionary savings that were built up during the pandemic. Households got very nervous. They didn't want to spend. They saved a lot. Then lockdown started to ease, and they spent all this excess cash. And now you can see that those blue bars are now moving into negative territory, telling us that that surplus of savings is no longer there. That means you're not going to have that same amount of demand pull inflation coming through. And so those are the three reasons as to why I believe that inflation is starting to show signs of topping out, of course, without the potential tail risk of China invading Taiwan. It comes with a little bit of a disclaimer, because I do believe that we're going to see a lot stickier inflation in countries like the US and the UK. Now, even though inflation rises have been broad-based across the globe, the extent to which inflation has permeated in the consumer baskets has been very different. So if you look at the US and the UK, and here we're looking at inflation for June, and I've just broken it down into where inflation has come from, you can see that some of it came from food and some of it came from fuel, but a very big proportion, and that's what you see in the red bars, actually came through from the remainder of the basket. So this means that we saw inflation outside of food and fuel. It means that prices in the rest of the economy has now started to pick up. This means that there is an element of demand-led inflation in these economies. But fortunately, monetary policy can do something about demand-led inflation. We heard Evangelina talk about the supply side factors and how can monetary policy solve that, and this is exactly the case. So we expect the UK and the US to raise interest rates by a lot more upfront because monetary policy can do something to combat high inflation in those economies. But as Evangelina pointed out, if you look at countries in the Eurozone or Japan, where inflation has largely been on the back of these exogenous factors of food and fuel, there's not much that central bank policy can do. And as a result, we believe that the monetary policy response is going to be a lot slower and the magnitude will be a lot less than what we're seeing in the UK and the US. Nevertheless, no matter where you are on the globe, to be a central banker is a very difficult thing right now. You are basically walking a tightrope. Because if you raise interest rates by too much or too soon, you actually risk pushing the economy into a recession. But if you take your time and you actually do too few interest rate hikes over too long period, you then risk inflation running rampant. That means that you then have to do even more interest rate hikes to bring inflation back, and that can hurt the economy even more in the long run. Now, we believe that front-loading the interest rate hiking cycle is something that's going to take place over the next while. Okay, now I need to go back. There, thank you. And we believe that the market expectations have also filtered this in. So you can see that the market believes that interest rates are going to peak reasonably soon in the US and the UK economy, but at a much higher level. Now, for as long as we have inflation not showing any signs of a consistent downward trend, central banks' mandate is going to be focused on fighting inflation. Once we start to see a consistent downward trend in inflation and the fact that monetary policy has worked, then central banks are now going to focus on saving growth. And as a result, we could actually see the Fed and the BOE even cutting interest rates before the end of next year. You can see that the market expectations for the ECB and the Bank of Japan are far more sanguine. Why? Because it's mostly food and fuel that's been causing high inflation, and much higher interest rates may not actually be as well received in those economies like it would in the US and the UK. Now, unfortunately, to combat inflation has a bit of a sacrifice ratio attached to that. So if we want to bring inflation back down to central bank targets, it's going to have a negative impact on growth. And what the Bank for International Settlement shows here for a number of countries ranging from the US to South Korea on the right is that if we were to bring headline inflation back to their respective central bank targets, there would be this impact on growth for each of these economies. So raising interest rates to combat inflation comes with quite a high economic price tag. Now, fortunately, what the Bank for International Settlement study has also showed us is that by front-loading the interest rate hiking cycle, the negative impact on economic growth may actually be squashed a bit. So what we've got here is there were 70 interest rate tightening cycles that the Bank for International Settlements looked at. 41 of them were associated with the so-called hard landing or recessionary conditions. The remainder, soft landing. And what they found is that typically in the red bars, you can see that traditionally when you have a hard landing that takes place, it's often associated with hikes that are much larger in size, both in nominal and in real terms. They tend to happen over a much longer time frame, and they tend to be a bit back-end loaded. When you have a typical soft landing that occurs in an economy, you tend to have smaller interest rate hikes, both in nominal and in real terms. It tends to happen over a shorter period of time because you started earlier, and they tend to be more front-loaded. And so what we're seeing now, even though most central banks, particularly in the developed market space, were indeed behind the curve for some time, they're now acting in a more front-loaded manner to try and achieve the situation where the impact on economic growth will be a bit more limited. Now, unfortunately, there are still ructions that are playing out in financial markets, and we can't all avoid the media, and everyone is very worried about the R word, recession. And what we saw for the first 2 quarters of the year was that the US economy has now been classified as being in a technical recession. Now, a technical recession means an economy slips into negative growth for 2 consecutive quarters. And as a result, we saw more and more print coming out with the word recession in news articles. So if we look at the sentiment out there, it's pretty much back to where we were during the global pandemic. However, we are not officially in a recession. So there's a body in the US called the National Bureau of Economic Research. There's a couple of people that sit on this board, and they determine whether the US economy is indeed in a recession or not. So they don't just look at whether the economy slipped into negative growth for 2 consecutive quarters. They actually look at a number of metrics, which I've listed here, things like payroll, personal income, employment, and so forth. And they've indexed these, and you can see that for most of these lines, we're actually above the 100-point mark, which means that overall, there are no signs in the US economy that are broad-based showing a decline in economic activity to the point that we are in a recession. Now, in my view, I do think we are going to see some softer growth coming through from the US economy, given that this has been an extraordinary pace of interest rate hikes. So we will see softer conditions. But there are a couple of factors that are quite different this time around to previous economic crises, particularly the 2008 financial crisis. Firstly, US banks are well capitalized. Non-financial corporates have healthy balance sheets. And because of all these stimulus checks that government has been writing, we find that households' net wealth position on the back of asset price inflation is also one of the highest in history. So this is a very different set of circumstances to when we were back in the global financial crisis. Nevertheless, I will say that I am quite worried. Okay, this does not want me to show this slide. Clearly, there's something very controversial on here. I am very worried about growth conditions in Europe, so Eurozone and the UK. And one of the reasons is because what is playing out in Russia and the fact that Europe is highly dependent on Russian oil and gas. Now, what we've seen is that even though we've had a number of economic sanctions on Russia imposed by the Western world, we haven't actually seen a deterioration in economic conditions in Russia. In fact, oil revenues have kept a very healthy clip and have continued to bankroll Russia's invasion in Ukraine. We're now into the 6th month of the invasion and still not really showing any signs of a decline. And what you can see on here is the black bar essentially tells us what the gas needs are of Europe. Now, Russia can actually cut off gas to Europe and still be economically okay because their oil revenues are doing fine. So if they go that route, which is again another tail risk scenario that could play out, what does Europe do? So Europe can potentially start to diversify their imports, so they get a little bit here in the blue bar. Then they could potentially run coal or nuclear, but harder, so you get a little bit more coming through. But then there is still this massive shortfall that won't be addressed. So that means in that particular case, places like Germany and France would then have to impose a demand cap on gas. And that's going to be very negative for growth, and I do believe that would then send the Eurozone into a negative growth territory for next year if that tail risk prevails. The European Central Bank, in addition to weak growth conditions, faces another challenge, and this is on the peripheral countries side. So we've seen that the bond yields for places like Italy, Spain, Greece, Portugal have once again ratcheted up. Now remember that throughout the pandemic, these governments spent even more to try and buffer up economic activity. And that meant that the fiscal position worsened and debt ratios started to climb once again. Now, during the pandemic, the ECB tried to keep interest rates low, and they expanded their balance sheet. So they were trying to mop up debt of these countries that couldn't really go out to market because there was just no appetite for it, unless bond yields were much higher to compensate them for that risk. But of course, now we're in the situation with high and rising inflation, and there's a lot of pressure on the ECB to actually start raising interest rates and to start reining in the balance sheet. That means that the ECB can't act as the backstop for these countries like they have in the past. So in order to address this, the ECB came up with a fancy new tool, which they called the anti-fragmentation tool. Now that tool was designed so that the ECB can go into the market and mop up the debt of these peripheral countries. Now why this instrument is very different to what we've seen in the past is that previously the ECB acted in a very independent manner. But now the ECB actually has to make a bit of a political call for once. So if you take Italy as an example, which has debt problems, we've also have political problems given the resignation of the Prime Minister, the ECB has to make a call. Is Italy going to be economically viable under the political leadership that may evolve over the next couple of months? And this is something, it's new territory for the ECB that used to be very independent. We're now starting to breach into a little bit of a political aspect. Now, as I said, there weren't very many countries that actually managed to shy away from high global inflation. And in fact, we actually saw emerging markets bearing the brunt of high inflation. Why? Because the bulk of emerging markets' wallet goes towards food and fuel. So at the extreme, we've got India on the right-hand side of this chart, where for a typical consumer, half of their consumer spend actually goes towards paying for food and fuel. Now we know that food and fuel, as I said, we're at the coalface of the global supply chain issues, and we've experienced massive price pressures in these categories. So it stands to reason that consumers in those countries are really feeling the pinch. And the Bank for International Settlements has shown us that typically when you have a rise in food prices or oil prices to the extent that we have now, you typically get periods of social unrest. And anecdotally, we've seen this playing out. Venezuela, Argentina, Sri Lanka, where protesters were swimming in the pool of the Prime Minister while he fled the country. And more recently, in the news yesterday, we also saw protests emerging in Bangladesh. Why? People are hungry. There are high levels of poverty, and these prices have continued to escalate. I would also point out that emerging markets face an additional risk factor, which is high interest rates across the globe. So as borrowing rates go up across the globe, borrowing for emerging markets where they've borrowed in dollars or euros becomes far more expensive. Now, some of these countries were experiencing negative growth conditions even before the pandemic hit. Now, think about a small exposed country that's reliant on tourism or exports that hasn't fully recovered post the pandemic, that have already spent a lot of their fiscal buck to try and support growth, that now are being pushed even further towards the fiscal cliff. What this chart shows us is that we now have the highest number of emerging market countries that are being classified as being in debt distress or in default. I'm not trying to say that we're going to see a replay of the Asian debt crisis like we did in the late 90s, mostly because this time around the very large emerging markets are in a much healthier economic nick than they were back then. But I am pointing out that we could potentially see a bit of a domino effect in your frontier markets, particularly those that were very exposed to tourism and exports during the pandemic and haven't fully recovered. So bringing it back closer to home, I know it's not home, but next door home. If we think about what's happened with the South African Reserve Bank, even though we managed to actually buck the trend of high inflation up until very recently, we had a very aggressive response from our own central bank back home. And going into the July meeting, we were anticipating that interest rates would go up by 50 basis points, as was the market, given that just 2 weeks before that, Governor Lesetja Kganyago was on Bloomberg saying that 50 basis points is probably at the high end of the spectrum. And then 2 to 3 weeks later, they slapped us with a 75 basis point increase. Now, this goes back to my point on the chart with the high world uncertainty index, with a very wide range of economic forecasts on growth and inflation. Forward guidance by central banks means nothing to investors anymore. If we look at the central bank's forecast on growth and inflation, they're changing just as much as the consensus. And as a result, things have changed so fast. Even in a 2 to 3 week period, there was enough information to suggest to the Reserve Bank that they should actually raise interest rates by a higher increment than what they had initially guided markets toward. Now, if we take that into account and the sentiment of the policymakers at the Reserve Bank suggesting that they're worried about wage inflation, they're worried about inflation expectations, they're worried about electricity prices, we're now expecting another 75 basis points at the September meeting, followed by 50 basis points at the November meeting. So that takes us to a peak of about 675. And I think by the time we get to November, it won't only be the Reserve Bank in South Africa that will be taking stock, it'll be all central banks. Now, if we look at the US, we've already seen one print of inflation coming in a bit lower than the previous month. But one swallow doesn't make a summer, so we need to see a couple more prints substantiating a bit of a consolidation in headline inflation. If we do see that coming through, it's then likely that the Fed is going to go a little bit slower on the interest rate hiking cycle and may actually pause. And similarly, in South Africa's case, the market is looking for the peak in inflation in the next month or two. And if we do see that peak coming through, we may actually see rates topping out around that 6.75%. If we are wrong on that and inflation continues to head up, or we get the tail risk scenario of a Chinese invasion into Taiwan with additional global supply chain disruptions and higher inflation coming through, then I think the door remains open for further interest rate hikes at the beginning of next year. And of course, that will have a negative consequence for growth, given that sacrifice ratio that we spoke about. Now, I just want to show you in the South African inflation basket, why did we buck the global trend? It's quite unusual for South Africa to move in an opposite direction to what's happening globally. And if we break down our inflation basket, there were a number of elements in the basket, I've listed 10 here, that spent quite a large amount of time since 2019 with inflation operating below 3%. So what this says is that most of these components spent between 35 and 40% of the time operating below 3%. And so this became a drag on inflation. Now, these items were predominantly in things like discretionary goods, so clothing, footwear, and of course, as consumers come under more pressure, they would rather spend on things like food than to buy new furniture. We also saw a suppression of inflation coming through on the rental factors, which I've highlighted here in red. We have a massive oversupply in the housing market, and that compressed rental prices. Rent is a very big component of services inflation, and as a result, that really contained inflation in the South African context. Now, what was causing inflation in South Africa? So what has been causing inflation in South Africa, and these are components that have spent more time trending above 6% since 2019, are things like food and fuel, but these are largely exogenous in factor. What about electricity prices? 40% of the time they've been operating above 6% in terms of pricing pressure since 2019. Now, again, this speaks to Evangelina's point about the supply side shocks in the economy. So typically when you have supply side shocks in the economy like this, there's not much that central bank policy can do. But we're saying that we're going to still see a very aggressive stance in the next two meetings by the central bank. Why? We are quite concerned about inflation expectations. Now, these are longer dated expectations. So this is the 5-year average of inflation in 5 years' time that is expected by analysts, businesses, and labor. And you can see that inflation expectations became de-anchored in the last reading, even after quarters and quarters of trying to get those inflation expectations down. And this is what the Reserve Bank in South Africa has referred to as inflation persistence, meaning that it's not just food and fuel. They believe that if inflation expectations start drifting up, labor is going to ask for more wages. That means that businesses are going to put up prices so they can protect their own line of profitability, and then it becomes a self-fulfilling prophecy. And they want to nip this in the bud, and this is why we're saying that they are still going to take a reasonably aggressive stance. So in South Africa, this is why they are worried that even though core inflation, which is headline minus food and fuel, is reasonably low right now, they're worried it's going to pick up steam given this dynamic that's currently playing out in terms of expectations. Now, again, I think there is going to be a natural cap to where we can actually raise the interest rate in South Africa, and that's because of that sacrifice ratio I spoke about. Now, even though there were many headlines that said, the SA economy is back to pre-pandemic levels, it wasn't a broad-based recovery. In fact, 6 out of the 10 economic sectors are still operating below levels that we saw in 2019. The picture is even worse when we look at the employment numbers on the right-hand side, where it's only agriculture participating that would really knock growth out of bed, and we don't think that this is the game that the Reserve Bank wants to play. So where do we think growth is headed from here? We've got a 2% outlook for this year. That comes off a very high base of the 4.9, the post-pandemic bounce last year. But we do think that growth is going to slow into next year. Predominantly, we are worried about the consumer. Going into next year, we've got lower asset price inflation, we have higher inflation and higher interest rates, and we think that this is going to continue to bite into consumers' wallets. So can investment maybe save the day? Well, in the short term, I believe not. 80% of manufacturers in South Africa say that they don't want to invest in the South African economy because they're worried about the general political climate. Now, we had our president coming out with some reforms on the energy side, and we think that some of that investment can actually boost GDP in the back end of next year. But we're unlikely to see much of that manifesting in this year. Now, it's not all doom and gloom. We actually have some good projects going on in government, such as Operation Vulindlela. It's a 5-year plan that government has implemented that will roll out at the end of 2024. There are great people that are working in that office, and they are doing a lot of projects in water, electricity, transport, logistics, so a lot of Transnet projects in there, the digital broadband spectrum, and then visas. And we have seen remarkable progress in a number of areas in those 5 priorities. But just to point out that even in some sectors where you think it's low-hanging fruit, government inefficiencies have tended to derail further progress. So I've got what's happening on the electricity front, and you can see those red bars where we could procure emergency power or try to improve our energy availability factor. Those factors have been hamstrung by government inefficiencies. Now, government inefficiencies in its worst form is called endemic corruption in South Africa, which has also been a massive drag on South Africa's economy. Now, this chart that you're looking at here is from the Fund for Peace, and they calculate what they call a fragile states index. So you don't want to have a high number here. The higher you are, the more fragile you are. And we're not in great company as South Africa. So South Africa is just highlighted in the red bars with the little black dotted line for ease of reference. But you can see that over the past decade, we've deteriorated on things like security apparatus, law enforcement agencies, prosecutions, the police force. And that has had negative repercussions for the overall fragility of our economy. Now, it's this exact issue, the security apparatus, that I'm going to end this presentation on. In terms of that security apparatus, we've had the Financial Action Task Force saying that we have deficiencies in South Africa's system to be able to combat terrorist financing and money laundering. Now, the FATF is an international body, and they have a whole bunch of policies in place to ensure that we can combat terrorist financing and money laundering. And what they've suggested is that in South Africa, we actually need to put together a credible plan to suggest that we are addressing those inefficiencies to be able to cater for combating terrorist crimes and financial crimes. Now, the cases that have been highlighted as deficient in South Africa is the fact that we have a high level of cash usage. Also, the usage of cash across borders is largely unaccounted for. We have capacity constraints in our law enforcement agencies, and these are factors that need to be addressed by October of this year. If not, and if we don't show enough progress up until February of next year, we could find ourselves on the grey list. Now, how do we go about doing this? There are certain technical stipulations that need to be fulfilled. And a couple of days ago, National Treasury in South Africa came out with a list of reforms that they are willing to embark on. But that's not all. So you've got the technical stipulations. I think those boxes are relatively easy to tick. You have to make some new policies, have some new reforms in place. But the one I'm really worried about, and what makes this grey listing issue so grey, whether we are going to end up there or not, is the fact that there is a judgment layer applied. So at the end of the day, it's going to all boil down to whether the FATF believe that we have government's willingness to embark on these reforms that they've set out. And that, for me, the answer is not so clear. Largely, the implications, I mean, you can get an economy like Pakistan that between 2012 and 2015, between 1% and 2% was wiped off of GDP because of the grey listing impact. Well, I want to end off the presentation on a bit of a sweeter note to say that these are not new problems. Investors are well versed on the problems that South Africa faces and the reasons that we could potentially be grey listed. So as a result, I think quite a bit of it is already embedded in local asset prices, bond deals, the rand, to mention just a few. So yes, maybe if we do end up on the grey list and things don't go our way, we could potentially see some fallout in the interim. But by and large, I think a lot of this is embedded in investors' expectations already. Of course, it does mean that we're going to have an additional layer of compliance. It's going to become more difficult to do business with South Africa. It does taint the reputation of our financial institutions, large and the small ones. But it also gives us a bit of an opportunity to be in an environment to fix the deficiencies so that we can become more competitive again on a global scale. So I'm hoping to have ended that off on a slightly positive note and quite a negative sentiment. And I'll leave it there and hand back over.
Thank you, Sanisha. Before we head on, are there any questions for Sanisha and Evangelina at this point in time? John?
So just what you said on the, sorry, firstly the presentation is excellent. There's a lot of these things and this is great. How do you see the rand against the US dollar in the next 6 to 12 months? And also the US against the euro period? What's happening there?
Yeah, so you partially answered your question because I think a lot relies on the dollar euro. If we see a very deep protracted recession in the US, we could actually have the dollar strengthening even further because it then acts as a safe haven currency. And so you could see that breach through parity breaking even further. And then of course with dollar strength, that would already put the rand on the back foot. So a lot depends on that. Now, I've mentioned in my presentation, our base case is for more of a softer landing to take place in the US economy. Which then suggests that we could be in a situation where that breach through parity starts to reverse again and the dollar then weakens progressively over time. We also tend to look over the medium term, we look at interest rate differentials between the US and the Eurozone to dictate that. The rate at which balance sheet reduction happens in those two areas, and then of course growth differentials. So typically those three things tend to drive your medium term forecasts. Which all suggests that the dollar should in fact weaken over time relative to the euro. In South Africa's case, I believe that the rand is going to be on the back foot relative to emerging markets longer term because our economic fundamentals are slipping. That chart I showed you on the Fragile States Index, I mean, even relative to like Mexico and Turkey, we are now looking shoddy. So I do believe we start losing ground against our emerging market peers. What's causing, I think the rand is a bit oversold right now. We've also had a very unfortunate incident where our finance minister has been pinned for sexual assault allegations. And there are concerns that fiscal consolidation may not happen now in the medium term. There are three names that are being flouted as potential replacements if the National Prosecuting Authority find him guilty and he's forced to step aside. But we don't know what the outcome is going to be. He played a very pivotal role on the Treasury side because one, he actually made quite a big statement about the potential extension of the basic income grant to say that maybe we should actually focus on creating more jobs and skills for the youth, and the market loved that. Secondly, he got very involved in the wage negotiations side, so to try and curb the public sector wage bill. And then thirdly, everyone knows about his tough love stance on the state-owned enterprises. So all three of those were very business-friendly proposals. So if he goes, and I think this is what's partly embedded in the domestic risk factors that are propping the rand to be so weak, is the fact that if he goes, we may not see the same push for fiscal consolidation. The rand also weakened recently alongside other emerging markets because the Fed said they're still going to raise interest rates even further. And so that, of course, spooked markets and it actually bid the dollar stronger. So I think it is a bit oversold right now, but I do see a weakening trend in general over the medium term playing out because of the weaker macro fundamentals. So yes, in the short term, maybe it comes back a bit because of that oversold position. But the general trend over the next couple of years is one of depreciation.
Thank you. Maybe just another question. I know that you alluded to the potential impact of something like Taiwan being invaded by China, but something like that, the Chinese housing crisis that's developing now, how do you foresee that impacting our world? Global outlook.
Yes, I think, the main impact for South Africa or emerging markets in general is what the impact is going to be for things like building material and commodity prices. Now, over the course of the last week, China cut lending rates again, and that was really to support what's happening in the property sector and to support the consumer. So we're already starting, I mean, Q2 was a terrible quarter. They had the worst lockdown since COVID-19 began, and the zero COVID strategy is hurting growth. But then we saw some of the lockdowns easing, and we saw cement sales starting to pick up, vehicle sales starting to pick up, so we could get a bit of recovery in the second half of this year. We are looking for a growth rate of 3.5 for China this year, but we do see it bouncing back to 5. Now, China, I said there were a handful of economies that did actually escape high global inflation. China and Japan were two of these, and a couple of others in the Asian region. Why? Because in the US, to solve the pandemic problem, they gave cash to consumers and they went out and spent, and we had demand inflation. Now, Asia's response was very different to that. China in particular, because they actually had infrastructure bonds. So that doesn't actually bid up your consumption numbers as much. So inflation is not really a problem in China, and that's why they can actually cut interest rates more. They can cut the reserve requirement ratio more. They can issue more infrastructure bonds. So their monetary policy toolbox is still there for them to make use of, and that's why we see that bounce in growth going from 3.5% to 5%. What can derail Chinese growth from here? Could be a potential invasion of Taiwan, because there would be some backlash from the US. So trade dynamics, which have gone a bit more positively under the Biden regime, could actually backtrack. There's also a lot in terms of the connection to the US in terms of the midterm elections that are coming up. More recently, I think Democrats have a little bit more grounding now, because we've got low unemployment, inflation is starting to come down. So things may be looking up for them. But if things go pear-shaped and Republicans gain more power, there will be a lot of push for more negative trade dynamics with China, and that could also then derail the China story. So in terms of the housing market, they're really supporting that through the interest rate dynamic.
Cynthia, do you need the mic?
You guys hear me? Awesome. Thank you very much for the presentation, and it's very insightful. You painted the macroeconomic backdrop, but would you be able to relate that to asset prices? So could we just have your thoughts around fixed income markets? That's what I'm interested in. Perhaps there are some people interested in the equity markets as well. And if you could perhaps also just say a few words about the Namibian fixed income markets.
Okay, so the Namibian fixed income markets I really cannot conclude on, so I'll ask my colleagues to help me out there. In terms of the asset allocation outlook, I don't actually cover that. It is covered by someone else, but I'll give a very brief overlay on how we view things. We are quite worried about global equities, especially the US, given that company profitability is likely to head lower, and the EPS forecasts are not really reflecting that negative outcome. So even though I showed you that chart on the media saying that the risk of recession is very high, the expectations in the market for earnings are actually quite elevated relative to expectations for a recession. So for those jaws to start coming in would then paint quite a more bleak picture for the equity side. Our fixed income head is quite positive on nominal bonds, and to the extent that inflation-linked bonds will obviously track higher with higher inflation. Cash, we've still got interest rates picking up, so that will be good for the cash asset class in the domestic space.
Are we talking about US or SA?
For South Africa.
Okay.
Yeah.
Any thoughts on that?
My voice loud enough. So I think now we do expect a general pattern of following South Africa as a base case, and on a relative basis. In the nominal bond space, we compare South Africa over Namibia. It's because of some of the fiscal issues or aspects in the Namibia. What we do have in Namibia is inflation-linked bonds, but they're a bit harder to get a hold of just due to more limited issuances in this space to operate there. So we're exposure to both of the slight tilt in the nominal space to South Africa or Namibia. And then in cash, we've been excess cash just as the rates increase cycle has been playing out, and we've started to deploy some of that cash into other high yielding
thank you for all the questions. Before you head into Jako, we've got two central bankers here, and I saw the message that Sanisha put 75 basis points and another 50 basis points toward the end of it. Please be friendly to them. It's not their fault. It's just the environment and the market they find themselves in, or we find ourselves in. And they're in the same boat. They also need to spend their dollars. At this point, I'd like Jako to come to the front and talk through our outcomes-based investment philosophy. And essentially, as you can see, our motto says, be here for your journey to success. And that outcomes-based philosophy, investment philosophy that we got, generally speaks to that. And like we mentioned earlier when I started, is that the journey is very, very important. It is very, very important. And we can help you navigate that. And here's the philosophy that guides us on how to help you navigate that journey that you're on. Jako.
Thank you. Can I grab that as well? Sorry, morning everyone. I just want to move this away a little bit. You don't have that on the Teams meeting to navigate. Good morning everyone. Really nice to see you. I think before I get going, I think it's just worthwhile to thank each and every one of you for both your attendance and your participation today. Certainly we haven't been, personally, I haven't been doing many of these in-person events over the last while, so it's really fantastic to see people in 3D or 4D rather than just on a computer screen. But then again, so thank you to you, first and foremost, and I guess also at the same time, Evangelina and Vaughan, thank you very much for your invitation for us to participate as well as the friendly and the warm welcome that we have received since we arrived. So we'll certainly be back, whether in a personal or a private capacity, or professional or private capacity. So I guess for me, as the slide said, of course, very important for me to talk a little bit about the outcomes-based investment philosophy. As you can see with the receding hairline, I've been part of this team and the grey for quite some while. I've been with the business for around 20 years. So really when we talk about philosophy, I mean, if you were to Google it, philosophy means the love of wisdom. And if you talk about an investment philosophy, it takes it one step further and it talks about, a certain set of guiding principles that guides your thinking, your decision making and the process. And it's really that what I want to talk about. So in actual fact, this is the kind of topic that you don't need slides for, but I do have a few that'll pop up in the background. And then, of course, following me, my colleague Mash would just talk a little bit about how we make it practical from a Namibian portfolio perspective. So when you talk about investment philosophy, and especially, and I know you've heard this word a lot. You've seen many a fund manager talk about how they view the world and their philosophy. And there are various philosophies out there. It could be one of buying low, selling high, one that looks at earnings growth and corporate profitability and so forth. But for us from an outcomes-based perspective, yes, it's important to work towards a goal, as Evangelina also pointed out earlier, but it's very important to manage for that journey at the same time. I think the overriding principle from an outcomes-based perspective is to keep clients invested and to manage for that journey. Of course, as human beings, we will all have an emotional connection to the market. I mean, as Sanisha pointed out earlier, things change and we get uncomfortable with certain things, we get comforted with other things. And it's that journey that becomes increasingly important, because I still believe, again, from a personal perspective and from a client perspective, is if you're uncomfortable and you don't know what to expect, that's really what that causes that discomfort in terms of what you're invested in. So again, from an outcome-based perspective, as I mentioned, it's part of the journey. It's the goal at the end of the day that we need to achieve, and it's how we go about that. So again, it's important for us to, at the front of that philosophy, to understand three key principles. Those are the time frame that you're invested in, the risk you're willing to take, and of course then also the eventual outcome or goal that you're solving for. But I'll touch on those specific concepts a little bit later to unpack it in a little bit more detail. And I think very importantly, what that tells you is that we are in a position where we can effectively also customize for solutions. And that's very important. That also, as we believe that not all goals and not all objectives are the same for everyone. We're not built that way, I guess. And for us to understand those principles means that we're able to create a solution that's grounded in almost the departure point as we see it is the strategic asset allocation of a portfolio. That provides us with, number one, a roadmap in terms of how we manage the portfolios. You can almost see it as Waze or Google Maps effectively, getting us from point A to point B. But at the same time, that's also the starting point and the true north that we as a portfolio management team look after or look for in terms of how we manage these portfolios on a daily, weekly and monthly basis. Now, of course, as I mentioned, there are 3 key principles that are worth considering in terms of the philosophy. Now, reading this from right to left, that also talks a little bit to the way we think about it. The fixed part of this equation is, of course, the investment term or the time frame. And as Mash will describe a little bit later on, we know that every solution needs a bit of time to come to the fore, to really we really need that time for all the risk premiums and the asset classes to deliver on what it is we expect from them. Again, as Sanisha mentioned, we've gone through a phase now that has been very turbulent for markets. Now again, working that back into an investment philosophy and a process and a portfolio means that you need to give these things time to actually come to the fore. So from a portfolio perspective, you typically find that our investment term is fixed, and we normally express that in terms of years. So we need those amount of years and sometimes a little bit more, because these are market-linked portfolios for the vast majority of times, we need time for those risk premiums to come through. Very important for us, of course, is the risk element. Again, the risk talks to the ability of clients to stomach certain market drawdowns. Now, and that's exactly the way that we express it as well. So you may hear the term called value at risk or capital at risk, and it's exactly that. So we've, from a portfolio perspective, also defined this very clearly or by saying that clients should expect through the cycle, or over the shorter term at least, normally a period of 12 months, that there may be an element of drawdowns experienced in the portfolio. Now again, depending on the risk calibration of those portfolios, it could be anything from 2% to 5% to 10% even, depending on the measure of aggressiveness. And through our modeling, again, we believe that we will be able to work and move within those parameters for the vast majority of the time. And then ultimately, if you look at the yellow cog on the slide, that talks to the investment outcome or the actual goal. Now again, that's something that we've moved away from a point forecast as well, because we do know that it's incredibly difficult for us to hand on heart say exactly what a portfolio is going to deliver. It is really a function of how markets react and what the opportunity set provides over a specific period of time. But what's very important, and as Evangelina also commented on earlier, is that we need to get to a certain outcome with a high probability of success. It's no use us saying that we'll deliver you the moon and the stars and we fall way short of it, because then everything does fall flat. Now again, if we look at it from a philosophical perspective, there are quite a few characteristics attached to an outcomes-based investment philosophy. First and foremost, it's, as I mentioned just now, it's founded on the basis of reasonable expected outcomes. So again, and I'll talk about it a little bit later on, but in essence, we do look at the asset class delivery does drive the outcome. Now, we look at history not to say that it will repeat, but we do look at history in terms of asset classes, in terms of understanding how they react relative to one another. We need to understand, and we do understand how they react relative to one another, to understand correlations, differences, and how they react in different market conditions as well. Because ultimately, as you can see on the bottom left, is diversification remains key. We're talking about diversification across asset classes, investment strategies, and on the mandate level. We quite often tend to stand still on the mandate level because that's sometimes almost the sexy part to talk about. It's whether you execute through, whether it's a momentum asset management strategy, or whether it's through one of the well-known investment firms out there. But in reality, the asset allocation is so much more important. But we'll talk about that a little bit later on. If you look in the yellow arrow, what we're saying is that philosophy isn't married to a specific style. Now, what I mean with that is, again, through philosophies, you know that the execution could be a value strategy, it could be a momentum strategy, it could be a quality strategy, for example. But we believe that there's diversification and strength in the combination of those. So again, what we see in our portfolios is that we're not married to one specific outcome in the market driving our returns, because we are diversified from that perspective. Of course, predictability remains key, and what Mash will talk about a little bit later on as well is that for all our solutions, once we've pegged down the investment term, the risk appetite or the risk target, is that eventual outcome that we're targeting is that we get there with a very high probability of success. So now I'm talking around 65 to 70 to 75% success. Otherwise, why do we do this? It's for exactly those reasons. I think you may have seen this from us before, but again, just to reiterate why the asset allocation decision is so important, is that we've done a lot of research ourselves, which is confirmed by global research, in that over time, you'll find that your asset allocation decision and your allocation to different asset classes, be it Namibian equities, SA equities, or global equities, to name a few, drives as much as 70 to 80% of your outcome. So that's why we, from a portfolio management perspective, also spend an exceptionally amount of time in terms of getting that right. We know that getting that right puts us on the front foot in terms of delivering success and getting us closer to our objective. The second part of that puzzle talks around investment strategies. Now, this is exactly what I spoke about earlier. What we do is, within equities, for example, is we look at which investment risk premiums or strategies drive markets over time, and we want exposure to those. So I mentioned value, quality, and momentum or trending as a style. Those we deem to be prevalent in most equity markets. Hence, we want exposure to those. The same goes for example, for the fixed income markets. Again, managers or risk premiums are prevalent in terms of duration or time, in terms of credit versus non-credit instruments. And we need to carefully look at those investment strategies and combine them in a way that, again, delivers or gives us a higher probability of beating the market. Only then do we get to the mandate stage. So once we've identified asset classes, investment strategies, only then do we go to the market and say, well, ultimately, we want exposure to strategies A, B, and C. Which investment managers out there do we believe are best positioned to actually deliver on that? So if we believe manager A is exceptionally good at managing fixed income portfolios or fixed interest portfolios, we could potentially allocate some assets to that person or persons or team. But again, as you will see on this slide, that contributes a very small portion to your end objective or to your success. What's very important though is that it's not symmetrical. So if you do appoint the wrong managers, they actually can do a lot more harm than good as well. So it's quite important for us from a manager research perspective that we know who the prominent players are, know what their skill sets are, and know who we can go to for whichever investment strategy. And then right at the end is, call it the other column. And this is where we say we can take tactical positions relative to our strategic asset allocations. We can employ, call it hedging strategies on currencies, etc. But that's really it's 9 times out of 10. It's driven from a risk management perspective. There are some opportunistic opportunities that we'll look at, but really we again believe that those are very small and infrequent in nature, but we have to tick all the other boxes first before we get to that point. In terms of the portfolio construction, if we look at all the OBI portfolios, including the ones we manage in the Namibian space, it's really founded then again on those 3 principles or those 3 steps. And you'll find that these steps correspond to the contributions or the drivers of returns over time. So step 1 talks about asset classes again. So what we do is we look at the characteristics of asset classes, whether domestic, offshore, whether listed or unlisted, and combining those into a holistic solution. The second part of the process talks about strategy. So again, this talks about within asset classes, how we can actually create something that is more robust and diversified. And then the last step of the process, again, talks to the mandate that I alluded to earlier. Now, it's fine to set a portfolio in motion and for us to manage towards a certain goal. But of course, that's just one part of it. That's the start of the journey. So very important for us, I guess from a portfolio management perspective, is the continued management of this journey and of this portfolio over time. And that's where we have our continuous meetings, investment committees, where we do assess the success of the portfolio relative to this journey. We look at it from an holistic portfolio level. We look at it at all facets of the portfolio construction process as well, to make sure that all these various components are delivering on what we expected from them right from the beginning. And if we feel that during this journey, the portfolio is perhaps in need of call it taking more risk or less risk, that's something that we'll do as well. So it's part of the journey, it's part of the management process. And this is, as you would expect from Momentum being the big corporate that we are, this forms a big part of our governance process as well. So through that, investment committees feed up into what we call our outcomes-based investment committees, etc., to make sure that the investment team do what it's intended to do. That we manage these portfolios in a responsible manner. Of course, investment management is nothing without research. Now, this is something that I'm particularly proud of that we have within the team. It's what we call the research hub, or the research hive, as it's actually been dubbed now. And it talks to all the busy bees within the team. And really, again, from an outcomes-based perspective, I think this is the cornerstone of everything that we've done over the many, many years that we've managed portfolios. And it will continue to support the investment integrity and philosophy over time. I did say earlier that philosophy means this pursuit or this love of knowledge. And this is exactly what for me at least, talks to exactly that concept as well. So as this talks to both investment research, opportunistic research, it's certainly something that we're very proud of and that we believe would give us a better competitive edge over time. Then quickly, again, Evangelina spoke about ESG a little bit in her opening address, and I think Mash will talk about it a bit later on as well. But as true as outcome-based investing is, and the importance that it places on individual clients and their investment goals, so do we believe that ESG, or responsible investing, forms part of this journey. Now, again, it's something that you may have heard from not just ourselves, but from other players as well. But what's quite important for me is that we don't just talk the talk, but we walk the talk as well. And from this perspective, I guess, looking at from a firm-wide perspective, we've been one of the first signatories to the United Nations Principles of Responsible Investing. It goes back many years. Again, we serve on many boards, committees, and input and industry bodies that talks to and looks to promote responsible investing over time. So again, with an active role play in that space, from a business perspective and from a team perspective, we've been slowly building this capability as well. Alongside the investment team, we do have our responsible investment specialists. In fact, we've actually hired a new lady just the other day that is as another ESG analyst, Levoyo, into the team. And so this team is ever growing, starting to look and feel very much like a legal team nowadays, looking at all the things we have to do. Well, from a legal perspective, we have to do, but from a responsible investing perspective, the stuff we want to do, very importantly. So again, this team is very involved in terms of setting and helping the investment team get more involved and be more vocal around responsible investing. And we report on it as well. This is a very extremely busy slide, but if we just look at the bottom right, for example, I think by way of example, just showing the amount of meetings the team attended, the amount of voting they've done in terms of, on a broad range of topics. But the thing, what I want to get across from this slide is exactly how active we are in this space. It's certainly not, I think the days of investment managers in general sitting on the back foot, waiting for things to happen. We are standing up and we're making a difference. And this is just a little bit of a testament to that. And I think that's, from me, in a nutshell, just a quick philosophical recap. As I said, it's something that I've, just about my entire professional career has been devoted to OBI. So from that perspective, again, it's something that I'm very proud of. It's something that guides my thinking, the team's thinking on a daily basis. And I certainly believe that it's the best strategy for investors. It's one that certainly we believe in and that we're passionate about. So again, thank you for your time. Really appreciate it. And Mash would make it a little bit real just now, unless there are very specific questions. Happy. Thank you. Thanks, Mash. Pointer, Mike.
Both. How does this work?
Depending on how you want to. Thank you.
I'm left-handed, so okay, thank you. And it's good to be out here. I think I haven't been in Namibia since pre-COVID, so it's good to be back here and see everybody looking good and well. Part of my role today is just to sort of take you through how we're positioned in the market, what is our offering, and then also bring together how the different components that you've heard from my colleagues, how we then package that into the solution and how we think about it on an ongoing basis and how we use that as part of our day-to-day portfolio management and execution processes. Okay, so this is what we refer to as our OBI window, which we try in one slide and in a nutshell to represent all the different solutions that we have and also reflect some of how we bring them together. So in the future, we plan to have an iPad version of this where you can just, with an idea of how we work, be able to just press a button and find a solution that's suitable for yourselves or for your clients. So we start, does the pointer work? Okay, not really. We start by looking at the range of different investment needs that are possible out there. And we frame it in terms of potential where there's a capital and liquidity requirement need. And moving up the spectrum, there'll be a greater interest in higher income yielding. And as we go past the income space, we start to have interest in growth asset classes, which are your equity-driven asset classes with the different regional exposures. And then after we get a feel for the need, we look at what are those asset classes that help me build up solutions towards meeting this need. In the capital space, naturally, it's primarily cash. In the income space, it's fixed income, which would be your cash, but then there you start to bring in other income-yielding assets, for example, bonds, nominal fixed income. You start to bring in a bit more credit. You start to bring in other elements. You could have some preference shares in there. And you could also have an element of property exposure in there where you have got comfort with the rental income subject to acceptable capital risk. And where the investment need is around growth with capital protection. Did I switch it off? This one. Middle one. Okay, let me go one back. Can I continue? Okay, we can work with the smaller ones. Okay, good eyesight in this room. With the real growth and capital protection, they're part of our flagship solutions is in the absolute return space. And in the absolute return space, the manager or the deployment of the strategy has got two objectives. One is to meet a real return objective, call it CPI +4 in the case of our momentum defensive growth. And also the manager has got a secondary objective to protect capital over rolling 12-month periods. It's not guaranteed, but they'll do their best efforts using the tools available to them in the market and also their day-to-day movements in the asset allocation space. And then where you want your long-term growth, we've got a range of multi-asset class solutions, and we partition them based on different risk continuums. And I think Jako did speak a bit around how we look at the time horizon as a key anchor of how you then package and what is an appropriate solution. And within the multi-asset space, I'll unpack these a bit more as we go along. We do have 4 solutions there, starting from the cautious growth with a set time horizon, targeting being the most conservative one, and all the way up to the Momentum Namibia growth, targeting local CPI plus 4 to 5. And part of the idea there is what we've tried to do is try to analyze just the full suite and full set of potential investor needs and try to cater for as much as we could within the constraints. So you find that we have a pretty broad range of solutions available within the market. And yeah, I've already touched on how the investment horizon feeds into the portfolios. So this is our solution set, and as we go along, we'll unpack what is underneath and just different facets of how these come together and play out on the ground. And then, yeah, I've already touched on that. So in the multi-asset space in particular, you've seen Evangelina has spoken about Namibia, Sanisha has spoken about South Africa and offshore, and Jako has spoken about our philosophy and process. So within the multi-asset space, those come together because we invest primarily threefold. We invest to meet domestic asset requirements of 45%, but typically we get up to around 50%. And then we invest offshore, so we'll show how each multi-asset fund has got its own target exposure, the max being 35%. Currently, we hover at a max of about 30%. And then the balance would sit in South Africa, which is roughly your 25 to 30 and a bit percent. So we're very diversified across all regions, and diversification being a natural pillar of our multi-asset solutions. And then this is just a different representation. And here we start to crystallize the different time periods. So cautious growth, it's over a 3-year horizon, stable growth over a 4-year horizon, diversified growth over a 5-year horizon, and the growth over a 6-year horizon. And these are available as either standalone solutions or part of an advice-led process leading up to a life stage. And depending on client circumstances, they could be packaged or put together in any combination as suitable for the client and the target market. Okay, this is where it gets interesting with numbers. So these are all our different portfolios. And then when we look at the risk budget that Jako spoke about, what we're trying to solve for there is the value at risk. And what that says is within any 12-month period, we put together the portfolio such that we try to ensure that the capital at risk does not exceed that much. What does that mean? So if you've put in 100 million, for the cautious growth, we're trying to make sure you don't lose more than 2.5 over any 12-month period while still exposed to the market. And based on that risk budget, this then informs all the different exposures to the underlying asset classes. Because we take all the history of the underlying asset classes, overlay that with the views we get from Sanisha and team, and then try to solve for each of the asset classes that I have available. What is that combination of asset classes that maximizes my probability of getting to the return target at the target risk level? So in a nutshell, this is the model that we then use to apply as the strategic asset allocation that we saw earlier, and then we then manage around that strategic asset allocation. And then, yeah, you see the range of asset classes that we utilize from Namibia, in South Africa, and offshore, across equities, bonds, cash, listed property, direct property, global equities. And then out of there, there'll be some supportive asset classes that you don't see explicitly listed, but where we see opportunity, for example, in the unlisted space, whether it's driven by regulation or not, would still be able to tap into other asset classes And the litmus test is always, if I'm going to use an alternative class to cash, I need to have conviction that I expect it to deliver better than the asset class that I'm using as my source of funds. And then when we look at all the asset classes, we then consolidate to say what is that level of exposure to growth assets that I need in order to solve for this. And then you can see how it evolves from the range from 40% growth exposure for the cautious growth targeting CPI plus 2 to 3, all the way to my maximum exposure of just under 80% for the growth asset class, for the growth which targets CPI plus 4 to 5. But in order to be comfortable here, you've got to be comfortable with the risk of potentially having an 8% drawdown over any 12-month period. So you can see that across all our asset classes, we target to always have under 10% drawdown irrespective of in any 12-month period, irrespective of the risk budget. And part of what this tries to align to is trying to keep clients comfortable and invested, because part of the research that we have done, or a lot of the research that we've done, has shown that when clients get uncomfortable, when the experience is very different from what they expect, then they can make suboptimal investment decisions. And then another important one, the offshore exposure, ranging from slightly over 15% to about 30%. So given our current views, we do not see a lot of value in utilizing the full 35% on a strategic basis. But on a tactical basis, a portfolio manager can upweight or downweight based on the views that they have at a particular point in time. Okay, this just gives a bit more color to what the underlying strategies that we deploy in our multi-asset funds. We've spoken about equity. In the Namibia equity space, we do have a blend of dual listed and local listed shares that we have exposure to. In South Africa, our core house view is what we call a smart beta fund, which is a type of enhanced index where the manager does try to construct their own index in a way that tries to harvest some style phenomena. And there we have quality, value, and trending. And trending having come up because you might see it referred to as momentum, but we did not want to call it the Momentum Fund because it would sound a bit funny. And then unlisted, we are currently running at the max legislated. Compliance is an important part in all the portfolios that we construct. So you'll find, for the most part, our portfolios comply with all the local relevant legislation. We have 3.5%. We're running it at the max currently at 3.5%, and we have 3 underlying managers. And they, in the local space, our ESG tends to play out within the portfolio or project. And there we have one of the managers providing trade finance to SMEs. And the case there is that SMEs are the pillar of economic growth within Africa, probably within the world. And they tend to be at a more fragile or vulnerable phase of the entrepreneurial development. So providing support to such agents of the economy is a strong part of our responsible investing. We have exposure to listed property via SA, typically run that at around 2%. Namibia also have a portfolio of 5 direct properties, including our head office and some retail exposure. It's been very profitable strategy through the volatility that I've been experiencing and has recovered quite strongly post-COVID and is currently delivering strong double-digit returns around 12 to 13% with a lot less risk as we're seeing from the global economy. So we're looking at some options of potentially adding to that exposure in the near future. Namibia and South Africa bonds, we have 2 managers in there and getting exposure to one strategy specifically focused on Namibia bonds. But because of the lower liquidity we alluded to earlier, we do have a 10% allowance to South Africa to facilitate liquidity. And then we recently introduced some flexible bonds because part of the experience that we went through COVID revealed to us that all is good and well when market conditions are normal. But when there's market dislocations or extreme movements, suddenly managers can't raise cash easily, suddenly managers can't express their views. So we've started to increase flexibility within some of the mandates, and The flexible bond manager has got, within the same mandate, has got ability to move into cash, to nominal bonds, into inflation-linked bonds, with just a lot less constraints in the day-to-day portfolio management. Absolute strategies, I've already spoken about that, where the manager has a specific focus on inflation-linked protection, and we've been adding to that exposure, particularly in the current environment where there's a lot of pressure with rising inflation, but markets not delivering to as expected. And then in the global space, primarily exposure to equities and bonds, and we'll touch on our global strategy just now. So our global strategy is also very ESG driven, and we've got an investment partner called Rubeco, who operates out of Europe. And their approach to ESG is more at overall portfolio level. So they have a couple of metrics that they track relative to the benchmark of the MSCI World. And they'll say, for example, on the score of greenhouse emission, we want to be 20% better than the benchmark, and they integrate that into their entire thinking philosophy process and instrument selection. So the overall fund is an ESG fund. And the main skills we're applying at this point in time is the quant skill and their sustainable investing expertise. June, a lot of red. And June was, the month into June and the quarter in particular we experienced sharp drawdowns in the market, and a lot of the reasons that Sanisha has been speaking about in terms of the buildup of different pressures within the global economy. There was really nowhere to hide. Double-digit losses or drawdowns in both Namibia and local and South African equities, and even if we look at offshore, it's shown in local currency at -5.5, but if you bring back the currency movement, it was actually around a 17% drawdown. The only positive yielding asset classes was your cash and your inflation-linked bonds and your Namibia bonds. So what does this mean for an investor? When this happens, what do you do? I think that's part of what I've been trying to showcase from the earlier presentations in staying the core and just awaiting that market recovery and having conviction in your views, whether you think this is going to continue to happen, which we don't, because when we look at our valuations, we're seeing quite a fair amount of value across most of our growth asset classes, and when we speak to our positioning, we'll show what that means. So what do we encourage investors to do here? Switch off the iPad if you need to, stay invested the course, and have a manager who stays on top of the different drivers in the market and feeds that through into your portfolios. We don't have the subsequent numbers here, but July we did see a fair amount of recovery with some of the asset classes already clawing back around half the losses. Not a full recovery yet. August has also extended the recovery, but it's become a bit shaky in the past week. But the idea is to stay invested while managing the exposure to the downside risk. And if we look at some of the longer-term numbers, we can still see that there's still value that has been delivered from some of the other asset classes, the growth asset classes in particular. And then moving on to our returns to June, we have a money market fund that has delivered a high ahead of benchmark across all periods, and inception date having been November 2018. And that is benchmarked to 90% Namibia IJG and a 10% allowance to South Africa STEFI, primarily for liquidity and giving the manager a bit of extra flexibility. And this has got a target duration of 180 days. Diversified income, so alluded to earlier, the manager then is allowed to expand the opportunity set, bring in some bonds, bring in some credit, and they try to add another 50 basis points per annum on top of the core money market, and that fund has also delivered well since in inception and is ahead of benchmark across all periods. Then our multi-asset funds, we've seen the numbers of what happened in the 3 months in the quarter to June, and we did experience drawdowns across the markets. But part of what we try to do is generally, especially when markets become highly correlated in terms of crisis, you generally can't escape the direction of the market. But what try to do is to limit the impact of the drawdown such experience relative to the market, while still being positioned for participation as markets recover. So it's for the 3 months between 3 and 6% drawdown experienced. We don't have the July numbers here, but July it's an average of between 1.5% to 2.5% of recovery. So we've already started to see some of the recovery coming through. 1 year, the numbers have come off quite a bit since 6 months ago, given what's the dynamics that have been playing out in the global economy, but still positive nonetheless. And given our position, we still do expect that numbers to incrementally creep up. We will reflect a bit of what we are doing in the interim in terms of managing around the asset allocation and positioning for the possibilities that we've seen being described in the economics and earlier presentations. Then on a 3-year basis, a mixed bag. Some funds close to the benchmark, some marginally behind. And the reality of the markets we operate in is there are some structural constraints that limit our ability to trade in and out of markets. So we tend to have more of a buy and hold strategy, and that does lead to benchmark mismatches here and there. But in aggregate, a very comfortable picture given, I guess, the opportunity set we have and what we're trying to achieve for our clients. And when we look at longer term, you can see that we are in line where we have the 5-year experience. We are in line or ahead of the benchmark. All in all, a comfortable picture relative to our asset allocation benchmark. In the shorter term, we do see that inflation pressure coming through in terms of the inflation-linked objective being higher than the fund experience, and that's a function of some of the earlier conversations we've had around rising inflation while markets are falling. And in terms of our views going forward, we do expect inflation beating returns from the different asset classes. So we are still staying invested in growth, but just managing entry points, valuations, and instrument and asset selection within that mix. Okay, so overall, how are we positioned? So we've been underweight global equity, and part of that was into last year, there was increasing concern around valuations and growing. Oh, is this a better one? Thank you. There was increasing concerns around the global picture, and so we decided to stay underweight global equity. But what we did do is we added protected equity, which gave us a bit of a hedge. So when we did some rotation out of the US, that's when the tech was at its peak. And at that time, we favored Europe, but we're not sure how the Russia-Ukraine aspect was going to play out. So we went in there with a margin of safety. So we went in there with 40% capital protection, which means that if we put in 100 million, even if markets fall 30%, we still got protected for that 30. So we wanted the exposure, but with a margin of safety, given the risks that were emanating and playing out. And more recently, we've started to tactically add to traditional global equity. Classic case of buying the dip in anticipation of the recovery, even if you don't have a strong feel for when, but we have got conviction in that valuations will unlock through time. On a regional basis, we are also favoring local Namibia and South African assets over global assets for some of the reasons alluded to earlier. And then zoning in on South African Namibia, we, again, for similar reasons, we had trimmed our South African and Namibian overweight equity position, given where valuations were. But more recently, we're starting to add back to that, just given the market corrections that have happened. Listed property, we've been structurally underweight the asset class since COVID, because I think a lot of our views have fundamentally changed with changes in appetite for office, work from home, technology, making it easier for people to connect and work from anywhere. Although there are some opportunities where we can be selective, such as industrials and manufacturing, where we're still finding value on there. So currently neutral on direct property, but as alluded to earlier, looking to add to that, because it's been a resilient and attractive asset class, given the environment that we're in. Overweight bonds, and part of that is based on the views that we have and the real returns that we expect to harvest from the asset class. And there we have a slight, I think I mentioned it earlier, that we have a slight preference for South African nominals over Namibian nominals. And we have also been adding to inflation-linked bonds given just the increasing risks around inflation as an outlook. And in order to fund a lot of these positions, we are reducing our cash positions because now we're finding other asset classes coming into favor. But while there's still a fair amount of risk, but when we look through the cycle and even through the potential for recession, valuations are looking attractive in selected asset classes, and we are positioning for that. And I think that is, yes, that's our story, what we're doing and where we are with the portfolios. Thank you.
Thank you, Mash. Thank you, Jako. Are there any questions for Jako and Mash? Don't be shy, please. They're waiting patiently. Okay, then we'll continue. I'll be doing the last presentation, which deals with basically what we're talking about here is, are there other ways to manage risk? We've got the overview that Sanisha and Evangelina has given. We've got the philosophy that Yaku has spoken us through, or talked us through, and then Mash has spoken about our portfolio positioning. So we thought, let's take it a step further, and let's look at other ways of managing risk within and managing uncertainty within the portfolios. And what we are talking about today is we're going to be looking at concepts such as guarantees for companies, for managers who predominantly want to manage the underlying risk. And then secondly, we're also going to be talking through the concept called smoothing and what that entails. And the simple truth is we've heard a lot about the risk and the uncertainty that's in the market. And we've spoken about the journey that we're taking you on, or that we look at and we want to travel with our clients. And the question is if you think about yourself in a boat on the sea, making your journey from one destination to another destination, the question is, which sea would you rather prefer? A calm sea, or would you prefer the rough sea? And essentially, that is the question that we are trying to answer today and help you navigate through those difficult times. Because what we understand is rough times do come through, and we have got the ability and we've got the technology that sits with us to allow us to help you navigate that. So the wave theory of volatility is that waves, they've got peaks and they've got troughs. They've got ups and they've got downs. And what we're saying is that, yes, through those ups and those downs, there's energy that's being generated when it's up. When it's quiet, there's not a lot of energy that's being exerted by the wave. And similarly to markets, there's a correlation. You need volatility in order for you to generate those investment returns. Because if there's no volatility, if you're not taking any risk, you're basically parking your cash your money in a safe vehicle. And essentially, the question is, can you have both? And we're saying, yes, you can have both with a certain level of comfort in managing both, in managing that on a sustainable basis. So the 5 items that we're talking about in terms of managing that is, number 1 is the smoothing concept that I mentioned earlier allows you to manage the volatility within your portfolio. So like I said, imagine you're in that boat. You are still going towards your journey, but in a lot more, in a comfortable way. You're navigating your way to your journey while still enjoying that same experience that you have. So it's not just through diversification in terms of the underlying portfolio that we're achieving that, but we've actually got a proven formula that allows you, a proven formula that speaks to how we're smoothing these portfolios. Number 2, when you're looking at smoothing, what it actually provides you with is downside protection. It provides you with downside protection that when the markets are falling, you're relatively comfortable. And in addition to that, as I've mentioned, we've got the underlying guarantees that goes with that downside protection that we're speaking about. So essentially, we've done two things. Number one, we've removed the volatility. We've provided you with the downside protection that's there. And these guarantees that we're talking about, they're absolute. You can actually measure the guarantees, and it provides you with that certainty on both your capital plus the growth that you've achieved on that capital. And in the next two slides, I'll go into more detail about what that looks like and what the formula actually tries to achieve. Jako mentioned that we are a big corporate. We're the third biggest insurer in Namibia as well as in South Africa. And essentially off the back of that, those guarantees are backed by the Momentum balance sheet, which means that there's a strong company backing those guarantees and you can rely on those guarantees. I'm not going to spend too much time on the diversification or the diversification that goes into the underlying portfolio. Mash has spoken to that already, but I do want to highlight that the philosophy, or what we're talking about here, the guarantees and the smoothing approach that we've got, that's over and above the portfolio management that goes in specifically in the diversified portfolio. And we are 100% transparent when we're applying the smoothing and the guarantees to this portfolio. And we do have a clear disclosure documents that guides that. Essentially, there's three returns that an investor wants, three factors that they're looking at. They want growth within the risk parameters over the longer term. They don't want to participate in volatility, or to a lesser extent, they want to do that. So in terms of that, they want to see a smoother return profile. And then they want their returns to match the outcomes. A member in a retirement fund, for argument's sake, there's various ways of looking at that member or the membership of a retirement fund. Younger member, more aggressive, so they've got time. We said that it's not about timing the market, it's about timing the market because growth is expected over time. But a member who is closer towards retirement might not have that time to recover from a market crash or crisis as we have experienced over the last 3 years. But similarly for companies, they're saving towards certain projects, certain goals that they want to achieve, that they're rolling out. This three items here apply to them just as much. And we are saying that we can assist you with that. And how this smoothing the underlying portfolio looks is simply put, the objective is capital protection, but the growth objective is a performance benchmark of Namibian inflation plus 4%. This is over the longer term. So Mash has indicated the diversified growth portfolio has got a return objective of CPI plus 4%. And we are saying that this portfolio, off the back of that, has got that same objective. And over time, you will see that the two converge. The smooth growth fund, as well as the diversified fund underlying portfolio, these returns converge. We've spoken about the asset allocation for the portfolio. So essentially, how does this work? Do you mind if I stop using the mic? I think it's more comfortable. Essentially, how does this work? So, Mbo, if you look at this blue line over here, you'd see that that's what markets normally do. They go up, they go down. And then the dotted line here is what the return is that you can expect from a smoothed fund. Now, to put that smoothing into context as part of this it's an overlay that's being managed by the actuarial team within the Momentum corporate space, and they provide this overlay over and above the underlying portfolio that's there. So when markets run, there's some reserve build-up, and we give it, and when the markets go down, those reserves are then allocated back to the members or to the investor. But over time, you expect these lines to converge and have a similar type of investment return for the investor at the end of the day. So I've given you an illustration of what that looks like. This is an actual return when you compare the underlying performance that we saw from the Diversified Growth Fund, which is the red line here. You can see the volatility, and this is based on actual investment returns over the last 13 years, 14 years of the fund. And then you've got the blue line, which is the Smooth Growth Fund. So as I've indicated, the markets give you the return over time, but there's other ways of navigating that. There's a way of getting the comfort that you need from your investment return without having to worry about the ups and the downs. Mash indicated that close the iPad, don't look at it now. And this is essentially what the Smooth Growth Fund does. It provides you with that extra layer of protection that says, yes, when the times are good, we're going to hold back, but when times are tough, you're going to get that back as well. And this is what the cumulative return on such a portfolio is. Like I said, over time, this blue line has grown. You've seen your underlying portfolio participate in the markets actively. And this cumulative growth shows that over time, they do converge and you get the actual return from the portfolio. And this is as a result of the smoothing that's being applied. Now, over and above the smoothing concept that's there, we provide a capital guarantee. Now, what does this capital guarantee entail? It's a 100% guarantee on capital plus growth, and it covers the benefit payment events that might arise from a fund. So there's two values that the Smooth Growth portfolio manages. Number one is the fund value, and number two is the market value. So the fund value are defined set events, which is agreed to ahead of time. If you take a retirement fund, the events that they've got clarified there is your withdrawals, your deaths, your resignations. These are a set of benefits that's defined. Medical aid funds have similar. And similar set of or framework can be put in place for corporates as well, who would potentially want to invest in something similar. And that means that when that event happens, the benefit is 100% guaranteed and it pays out. And then there's a market value to the fund. We've seen that the underlying portfolio goes up and down. The fund is managed off the back of a reserve account. And when that reserve is negative, you would expect members to stay in that reserve because their benefits are 100% protected. A corporate, your benefit event is 100% protected. But when you do decide to switch out of that portfolio, it's deemed to be anti-selection because at the time you need the portfolio most, you are choosing against what the portfolio actually provides and guarantees for you. And as a result of that, you are selecting against the fund, and then you will get the market value adjuster that's being applied. Essentially put, this portfolio is not allowed to declare negative return, and returns are called bonuses within the Smooth Growth Fund. These bonuses are declared monthly upfront based on the formula that I've indicated, and there's two components to the bonus. There's a vesting and there's a non-vesting portion, which is essentially how we manage the capital guarantee at the end of the day. And I've already mentioned the fund value and how that gets paid out. So before I head into this last slide, just to close out, I've said that there's various, we find ourselves in unique times, and that has been stressed by Sanisha as well as by Evangelina. We've spoken about the philosophy and the way we go about investing. And we believe that the portfolio we've mentioned now, the Smooth Growth portfolio, and the technologies of either the guarantees that's being applied as well as the smoothing that's being applied can definitely be a game changer in the way you manage your funds, in the sense that it allows you to actively participate in markets. It allows you to get the growth exposure that you need for your members to generate, or for your corporates to generate that investment return or enhance the yield to make the income statement look better over time. but at the same time, it provides you with the protection in the sense that you don't have to participate when markets go down. And if you think about a retirement fund member over the last 3 years, I think quite a few trustees have gotten a lot of questions. Quite a few investment professionals have gotten a lot of questions around the emotional impact that the volatility has had on these members. And as a result of that, they are uncomfortable with the investment options that's there. And this solutions actually provide for that. It provides you with that comfort. It provides you with that certainty and outcome over the time frame that you're looking at. And essentially, that is what we want to do. So if there's a need for us to have a discussion around looking at smoothing, and if it's possible to add smoothing to some of your investments or underlying investments, please feel free to come to us. That's exactly why we've set up this session. And just to end off, we've spoken about, I started off the session with the journey. Jako has gone into how we understand the outcomes-based philosophy and what we're looking at, making sure that we look at the appropriate investments for you on that journey. And both of those factors will lead to the right outcomes. And this is all off the back of a robust process that we've put in place. And the one thing about the solution that we're talking about now, or the solutions that we're talking about now, is that it's all in the confines of an insurance policy. Whereas from a retirement fund perspective, you've got your Regulation 13 compliance, and from an insurance perspective, you've got your Regulation 15 compliance. And if you're a pension fund and you've invested in this type of vehicle, you're exempt from your Regulation 13 compliance because it's an insurance policy, and the insurer needs to make sure that they keep compliance with the underlying investments that's invested there. So essentially what this means is it gives you a bit more scope to operate within your Regulation 13 investments that you've got. Okay. Thank you very much. Are there any questions? Okay. I think everybody's ready to go on the long weekend now. So I'll hand over to Frikkie. Frikkie will just close out the session for us.
I'm not going to be making use of the mic because I was afforded a very fortunate opportunity of the last slot, the easiest slot, the shortest slot. So thanks, Vaughan. I think just before we close out completely, I think there's one last video clip that we'd like to show you. And I think even though we're making reference to South Africa in the clip, it can very much just be applied similarly to Namibia. We are neighbors, and we know we're friendly neighbors, so I think let's have a look at it. It's one last clip, if you can give us a couple of minutes of attention, and then we'd just like to close out this morning's session.
At Momentum Investments, responsible investing is not just another checkpoint or bullseye to hit, but it is integral to the way that we think about things. It is embedded in our DNA and plays a large part in how we operate and make plans for the future. We continually train our staff to be able to take advantage of any opportunities that arise within the responsible investing space, and also to be aware of any risks that may come with those opportunities. We are committed to have a heightened focus on 6 of the Sustainable Development Goals set by the UN. And that is our standpoint, that responsible investing is not just something to do, but it should be who you are as a business. With our internship program called Pambili, we took students and brought them into the business for 18 months. We are committed to diversity through creating opportunities and developing talent in the investment management industry. We have trained the interns in the various areas within the business, from portfolio management, institutional operations, and distribution, allowing them to gain as broad a base of skills as possible. We believe the future is in the hands of the youth, and we are actively playing a role in equipping them with the skills and experience to be better career professionals of tomorrow. We believe that South Africa's growth is locked in social infrastructure. By investing in students' accommodation in Pretoria, malls in undeveloped areas such as Imalahleni Mall, we believe we are setting a course for South Africa to grow. When it comes to diversified infrastructure, we actively invest in projects to increase roads, telecommunications, water and sanitation, as well as increase solar and alternative energy. factors we believe to be the groundwork for a successful economy. And with the growth of our country, we have an opportunity to also grow as an organization. And that forms an integral part in the way in which we invest. We always look for an opportunity to reinvest in the community and to make a change in the lives of people. Because with us, investing is personal.
Thank you. Yeah, I think in closing, I'd first like to just thank all of our stakeholders this morning, clients, future clients, potential clients, business partners. I know, like Vaughan said, we're right at the beginning of a long weekend, but we do appreciate you affording us this time this morning to share some of the solutions, some of the innovation that's still coming from Momentum. I think looking at the overall macro picture, it's not all doom and gloom. There are certain things that we do need to be taking note of and that we do need to be taking into consideration when making these decisions and giving advice to you, our clients. I think it's important for us to just share the innovation that's coming through. When Vaughan spoke about our Smooth Growth Fund solution, we're going back, we're revisiting the solutions that we had on the table previously. We're dusting them off, we're getting them ready as alternatives because we've identified that need in the market. And I think it's important for you as stakeholders to know, what the philosophy is around it. What Jako spoke to specifically is how do we look at it and how do we structure it uniquely and for the benefit of you as the investor or the individual at the end of the day. I think that was sort of it in closing. We'd like to engage you again in future. I'm sure this won't be the last of these types of engagement. I think it's because of the long weekend that we maybe were hampered with the numbers, but I'm sure that we got the audience that we were targeting, and we hope that we got that message across. So if there are any other questions afterwards, I'm sure the team will still be around. We're still packing up afterwards, but feel free to engage, feel free to ask those questions that you maybe didn't get to during the session. And once again, thanks for joining us this morning. Enjoy your long weekend, travel safe, and hope to see you next time. Thank you. Thanks.